Okay, hello everyone. Welcome to another awesome OctaFX webinar. We're still on the online workshop for complete beginner series, and today we'll be looking at first steps in trading. But before I go to talk about the talking points of this webinar, you can go ahead and type in the comment section your name and where you're watching me from. Go ahead and type in the comment section your name and where you're watching me from. If this is your first time attending this webinar, so what we do is we give you guys valuable information that would help you or guide you on your journey to be a profitable trader, so you don't fall victim to mistakes that would cost you money. So welcome. We have Kehinde Victor from Nigeria. Welcome. David Matthew from Nigeria. Oh, okay. Promise from Nigeria. Joseph from Zambia. Wow, welcome. Paul Okori watching from Enugu State. Trust Michael from Nigeria. And Blessing Okoro from Nigeria. Okay, so today we're going to be looking at some really important topics that you should know as a beginner. We'll talk about buy and sell orders, we'll talk about margin, we'll look at spread, important topics that you should know as a beginner trader. In the course of this webinar, if you have questions at any point in time, you can go ahead and type your questions in the comments section, and I'll look to answer your questions. Okay, Elizabeth from South Africa, Chimi from Nigeria, Tabiso from South Africa, Mohammed from Abuja, and Jacobs Moses from Nigeria. Massive welcome to you guys. Before I go to talk about the content of today's webinar, let me tell you guys about bonuses that you can get from just watching the webinar. The first one is 100% single use deposit bonus per series. And how do you get this 100% single use deposit bonus? The first thing you need to do is to sign up or confirm your participation on the OctaFX website. So you go to octafx.com and sign up, confirm your participation. The second thing you should do is to watch all the webinars from this series, and you wait for an email from OctaFX confirming that your bonus is ready. You initiate a new deposit request and you check claimed deposit bonus for this deposit. The bonus expires in 16th of February 2022. Okay, you also get a free trader's guidebook in PDF. And how do you get this free trader's guidebook? You watch all the webinars from the series, you stay active, and ask questions and answer my questions, and you get your PDF handbook via email once the webinar is over. All right, the first thing we'll be looking at today is what are buy and sell orders. Okay, an order is an instruction sent to your broker to open or close a transaction. It could be a buy order or a sell order. Now, we have two types of orders in the Forex market. The first one is the market execution, and the second one is pending orders. Market execution is an order that is instantly executed at a price that your broker has provided. A market order could be a buy order or a sell order. What this basically means is you're executing at market price. Okay, you're executing at the price that your broker has provided. Let me put up my... Okay, so let's say, for example, you want to... So let's say, for example, you want to trade USD JPY, which is the US dollar against the Japanese yen. Let's increase this a little bit. Okay, so you know about the ask price and the bid price. Now, if I'm to go ahead and just click on a sell right here or a buy, I would be doing this at instant market price, which is the price that my broker has provided for me. This is the price that I can sell at, and this is the price that I can buy at. So for example purposes, I'm just going to be clicking on sell. Yeah, now as you can see down, the order has been executed instantly. You can see it down here, sell USD at this price, which was the price the broker provided for me to sell. And the important thing to note is that the order has been executed instantly at the click, right? So that's what we mean by market execution. You're placing your trades at instant market price, and your orders are executed instantly. Okay. The next type of order is pending orders. Pending orders are like orders that are to be executed at a later time at the price you specify. The trade will not be active until market price gets to the specified price. A pending order could be a buy limit, a sell limit, a buy stop, and a sell stop order. Now, before I talk about pending orders, let me just quickly tell you guys something about market execution. So most times you could see like a price or a place that market is currently at, or you could see like your ask price and your bid price, and remember you're placing your buy at the ask price. Right now, before you go ahead to click on buy, you'd notice that the price has changed, right? That's because some markets are quite volatile compared to other markets. So it's important that you understand how volatile a currency pair is before you trade. Okay, you don't just want to jump into the market and start placing buy or sells, and then you find out that okay, you've experienced a slippage, or your entry point was different from the original price you wanted to enter. Okay, so it's important that you understand how volatile the instrument you want to trade is, so you then get to buy at 114.32, and due to volatility, price goes down or goes up and executes your trade at a different price. Okay, so pending orders, right? We have buy limits, we have sell limits, we have buy stop, and we have sell stop. Okay, in order to find where these pending orders are, you just go straight to new order and come down to type of order, right? Then you're going to see pending orders. Now under pending orders, you choose which type of pending order you want to place. Okay, I'm going to give you guys a detailed information on, or a detailed explanation on how these pending orders work, but just to give you guys a little recap, on market execution you can only buy and sell, right? Instantly you can buy and sell at the price the broker has provided for you instantly. On pending orders, you can place buy limit orders, buy stop orders, sell limit orders, and sell stop orders. So this is just to show you guys the different types of orders that you can place under instant market execution and pending orders. I know this is, you don't really understand what buy limit or sell stop or buy stop and sell limit is, so I'm just going to go ahead and explain limit order for you guys. So a limit order is an order placed to either buy below the market or sell above the market at a certain price. Remember, the easiest way to understand the things you learn in the forex market is to take the definition and just kind of place it on the chart, like copy the definition in your mind and then place what you've read, what you've understood on the chart. So a limit order is an order placed to either buy below the market or sell above the market at a certain price. This is an order to buy or sell once the market reaches the limit price. So once the market reaches the limit price, the order is triggered and executed at the limit price. The first type of limit order is buy limit. You place a buy limit order to buy an instrument at a specific price below current market price. Okay, so for buy limit, you're placing your order below the current market price, and for sell limit, you're placing your order above the current market price. Let me give you guys an illustration on how buy limit and sell limit orders work. So like I said, you take the definition and you just apply it on the chart. So for buy limit, you're placing your order below the current market price. Where is current market price? current market price is at 144.34, right? So you guys can see that clearly. Okay, so you see this this black line 114.33. That's where market is currently. That's the current market price, right? Now you're placing your buy limit order. Remember, it's an order that is placed to buy below current market price. So you're placing your buy limit order below the current market price. So if I go ahead to, if I decide to place a buy limit order on this instrument right now, this is for example purposes. Remember, I'm not asking you to place a trade on USDJPY on your trading account. But if I go ahead to place a buy limit order, remember, you go to type, go to pending order, and then you click on buy limit. Right now, I'm looking to place this order below the market price. Right? If I try to place this order above the market price, let's see what happens. So this is 114.754. Remember, market is at 114.34. So if I try to place this order above the current market price, 754, the order is not going to be placed, right? Because buy limit orders are below the current market price. I just really want that to, get you guys to get the information. I really want you guys to understand that for buy limit, your orders are placed below the market price. So I'll go ahead to, let's say I conduct an analysis, and my analysis tells me, okay, price is going to test back at this zone and this support and bounce off. Remember, you don't just come to the market and place pending orders or buy and sells. Your orders should be backed by an analysis, right? So let's say I'm placing this buy limit order right here, 113.561. I go ahead and click on new order and go to pending order, click OK, buy limit. Now I'm placing this order below the current market price, 113.561, and click on place. Let me take all this out so you guys can see clearly. Okay, so if you can see that the buy limit order has been placed. Now this order is not going to be active until market price gets down to this point, specifically the ask price. The ask price has to get down to this point before this trade becomes active. Now once market gets to this point, it realizes that you have placed a pending order. It reads your order. It's a buy, right? You're placing this order in anticipation that once market gets to your entry point, which is this buy limit order, you're expecting the market to move upwards to react to your order, which is a buy, right? You make profit from buy trades when markets move upwards. So you're expecting the market to come down and move upwards for you to be in profit. For sell limit is the opposite, right? For sell limit, you're placing your pending order above the current market price, expecting market to activate or get to, expecting market price to get to your entry point for your sell limit, activate and come and move downwards, right? So let me give you guys like an example. Let's say okay, so let's say I do some technical analysis and my analysis tells me market is going to retest this zone and drop back, right? I may not be when you place pending orders, most times your orders don't activate. Your pending order doesn't mean that markets must get to that point, right? The advantage of pending orders are so that you'll be time flexible. Like I could have have a schedule. I could want to see a movie I could probably have an online webinar for you guys, and I may not be able to look at my phone constantly. This is why we use pending orders as traders. Okay, so for sell limit, you're placing above current market price. So we're using this example 114.844, right? So what do we do? Let me take out this horizontal line, 114.844. So we go to new order. The same way, go to type, go to pending order. We're placing a sell limit, and remember, you're placing your sell limit above the current market price, right? So we set 114.844, and you click on place. So this order has been placed. Now, for it to be active, market has to move upwards. Market has to get to this point where I have executed this trade, where I have placed this order, and market has to execute. Specifically, the bid price has to get to my entry point, and then I expect the market to come down for me to be in profit. If the market goes up, I wouldn't be in profit because my pending order was a sell, right? You make profit from sales when market goes downwards, right? So that's for limit orders, buy limit and sell limit. Remember, when you place pending orders, you need to use stop loss and take profit levels. So you don't just want to place orders and leave the market like that. You need to also put stop loss and take profit levels. Any questions on sell limits and buy limits? So I can talk about the next type of pending orders, which is the stop orders. If you're just joining now and you have questions, you can use the comment section. I'll constantly check the comment section to see if you guys have questions. Okay, let's talk about stop orders. A stop order is an order placed to either buy above the market or sell below the market at a certain price. This is an order to buy or sell once the market reaches the stop price. Remember, once the market reaches the stop price, the order gets triggered and executed at the stop price. We have two types of stop orders: buy stop and sell stop. Now, you place a buy stop order to buy an instrument at a specific price above current market price. You place a sell stop order to sell an instrument at a specific price below current market price. Now, the general idea behind buy stop and sell stop is you're placing these orders, in anticipation that once your order gets triggered, market moves in, the initial direction. For example, let me clear. So I'll just go ahead and close these limit orders because I think I've explained how limit orders work. So we're going to talk about stop orders, right? And remember, for buy stop, your buy stop order is placed above the current market price, right? So, like I said, example, I conduct a technical analysis and it tells me market is going to probably get to this point, break out and continue, with the upward movement. Let me put this here. Okay, so like I said, buy stop, you're placing your buy stop order above the current market price in anticipation that your order is going to get triggered and market is going to move, in the initial direction. This was an uptrend, right? If your stop order gets triggered, market is going to react to what order it was. So your order is triggered, market checks, it's a buy, right? Let me just do that for you guys. Let me show you guys exactly how it works. So new order, Same way, go to type, go to pending order. Now we're talking about buy stop. So 114 point what was it, 731. Yeah. Okay, so what market is going to, what you're placing this buy stop because you're expecting market, or because you've done your analysis and it's telling you that market is going to get to this point and continue going upwards. You're placing this buy stop because you may not be on your phone when the market gets to this point, or you may not be on your PC, your laptop, your trading system, whatever you use. You may not be on it 247, right? You may have a football match to watch. You may have something to do, right? So you're placing this pending order, and you're telling your broker that if market gets to this point, buy this instrument for me. So market is going to get to this point and it's going to react to your order. What was your order? A buy. Then market starts going up, puts you in profit, or if it goes below your order, then you're going to be in a loss, which is why I always tell you guys to use stop loss and take profit levels. Now for sell stop, you're placing your sell stop order below current market price, right? Remember, the market price is this right here, 114.35. You're placing your sell stop below. So same example, let's say I conduct a technical analysis and it tells me market is going to get to this point and break below to come down. I may not be on my phone to observe when market gets to this point and break down before I initiate an instant execution. So I can just place a sell stop order. How do I do that? Same way, take this out. Okay, same way, I go to new order, pending orders, come down to sell stop, and where was it? Okay, so let's say 113.890. So the pending order has been initiated, and market has to, before the trade start reading, before I start moving in profit or loss, market has to come down to, market has to get to my entry point. Specifically, the bid price has to get to that point and activate, and the market moves downward for me to be in profit. Okay, so if market comes down to the sell stop and start moving back upwards, then I'm not going to be in profit, because initially my order was a sell. All I just had to do was tell the broker, don't sell right now, wait for market to come down to this point, then sell. So if market gets to that point and it doesn't go downwards, then I'm not going to be in profit. But if it goes downwards, then I am going to be in profit. Okay, okay, I'm checking to see if you guys have questions. Okay, so let's just do a quick recap. Buy limits, you place your buy limit order to buy an instrument at a specific price below the current market price. So let's use this illustration as an example. The blue dot is market price, your buy limit is the green line. So you're placing it below the current market price, expecting the market to trigger your buy limit order and move upwards. The sell limit, you're placing above the current market price, which is the red line, expecting market to get to your entry point and move downwards. Okay, for stop orders, you're placing your buy stop above the current market price, expecting or in anticipation that once it gets triggered, markets would continue to move upwards for you to be in profit. For your sell stop, you're placing your sell stop below the current market price, expecting or anticipating that market is going to trigger at your entry price and move downwards. Okay, the next thing we're going to talk about is margin. What is margin? Margin is a good faith deposit that is needed to open a position and keep it open as determined in the contract specification for each instrument. This deposit is locked up for the duration of the specific trade. Now, once the trade is closed, the margin is freed or released back into your account and can now be used again to open new trades. So margin is simply a portion of funds that your Forex broker has set aside from your account balance to keep your trade open and ensure that you can cover the potential loss of the trade. Okay, now OctaFX has an amazing trading calculator that you can use to know the required margin for your trades. How do you locate that calculator? So you go to octafx.com and then you go to analysis and education, and you come down to trading calculator. So you have two trading calculators, one for MT5, one for MT4. Whichever one you use, you can just go ahead and use whichever one of these trading platforms you use. So remember, the example we are using is $1,000 account, right? And we are trading USD JPY on we're trading USD JPY to give the examples on buy stop and sell stop and pending order. So I'm just going to still use the $1,000 account. So let's say I want to place a trade on USD JPY, right? Still using the $1,000 account. My leverage is 1 to 500, right? If you're using a lesser leverage, you can go ahead and select the one you use. You have a video that talks about leverage in detail. It's in the description box. You'll see an English playlist in the description box, so you can click that after this webinar to understand better about leverage. So 1 to 500 leverage on a $1,000 account. What does this mean? This means for every $1 in my trading account, I can control, or I can buy or sell 500 units of a currency, right? So for every $1 in my $1,000 account, I can buy or sell 500 units of a currency. Now for $1,000 in my trading account, I can control 500,000 units of a currency, and 500,000 units is 5 standard lots, right? I don't want to use 5 standard lots because I shouldn't be risking my entire account on one single trade, right? So let's say I want to risk 1% of my trading account on a single trade. That means I should be looking to risk 1% of 500,000 units, which is 5,000 units, right? 5,000 units is a micro lot, 5 micro lots. So go ahead to use 0.05 lots, and then I click on calculate. Now if you use euro, you can switch to the currency that you use to trade, but most of us US dollar is popularly used, so I'm just going to go ahead and use US dollar, and I click on calculate. Now OctaFX is going to tell me the required margin to keep this trade open. So go ahead and take advantage of this trading calculator so you know the required margin for your trade. All you have to do is just make sure your leverage is correct, look at the currency pair that you want to trade, and impute the lot size. So if I decide to use 5 standard lots, my required margin is going to be my entire $1,000 example account, right? And you shouldn't be looking to risk your entire account on a single trade. Okay, so that explains margin. We're going to look at margin level. What is margin level? Margin level is a relation between account's current equity and required margin. It's calculated as equity divided by required margin multiplied by 100. Now, the higher your margin level, the healthier your trading account. A low margin level has a negative impact on your account, so it's important that you pay attention to your margin level. So as you can see here, the margin level is 50,413%. Now if I'm in profit, my margin level increases, but the more money I lose, the lesser my margin level, the more money I lose. Okay, so pay attention to your margin level. We're going to look at free margin. Free margin denotes the funds in the client's account which may be used to open a position and are available for withdrawal. Free margin is calculated as equity subtracted by required margin, and then you get your free margin. So I left this USDJPY trade open, and this $2 margin is trying to tell me that my broker has set aside $2 from this trading account to keep this trade open. Right now, free margin is telling me that I have, remember the balance is $1,008.57. So free margin is telling me that I have $1,006.17 to open a new trade. Like I have this amount of money to open a new trade or to withdraw from. Okay, so if my profit or loss, if my profit increases, my free margin increases. If my trade is in loss, then my free margin reduces, just like you have here. Okay, I think that's pretty understandable. So free margin tells you this is the amount that you have to open new trades, or this is the amount that you have that you can withdraw from. Okay, margin call is, someone saying something about deposit bonus. Now your deposit bonus is part of your free margin until the volume requirements are met. So there are requirements that you should meet in order to get your deposit bonus, but until then your deposit bonus is going to be part of your free margin. Okay, margin call is a point at which additional funds may be required to maintain open positions should the market go against the trader. So the broker is going to send you an alert, or your broker is going to notify you that, okay, at this point you need to add more money to your account, to hold your trades, because you're at the verge of losing all your money. So you can either close this position right now or add more funds to your account to hold the trade. You only get a margin call notification if your trade is going against you, and if you're at the verge of losing so much money in your account, almost all the money. Okay, I'm just gonna check the comment section to see if you guys have questions. Okay. The next thing we're going to look at is equity. Now, most traders, misplace equity for balance, or they get confused with equity and balance. Equity is the amount of funds on a trading account that includes balance and floating profit and loss. When there are no open positions on your account, your equity is equal to balance. Like I said, the easiest way to really understand all the big names, the grammar, really understand how this whole Forex thing works is to get the definition and apply the definition to your trading platform. So how do you calculate your equity? Your equity is equal to balance plus profit, or balance plus loss. So let me just go to this example that we've used. Close this. Okay, so remember the balance is $1,008.57. Now, why is my equity different? That is because, remember, equity is balance plus or minus floating profit or floating loss. So what just happened is my balance was subtracted by my profit or loss. Right now I am down 31 cents on the trade I initiated or executed, the instant trade, with the example. I'm down 31 cents. So my equity is just my balance minus or subtracted by whatever is going on here. If it's a profit, if it's a loss. If it's a profit, then it's going to be my balance plus whatever profit I have here. So let me just do that calculation real quick so you guys understand. Balance is $1,008.57 multiplied by subtracted by 31 cents. So you see why the equity was $1,008.26. Now the equity is lower because I'm down 39 cents right now. So if I was in profit, the balance is just the equity is going to be the balance plus the profit, and then I get the equity. So the equity just tells you like this is the total amount you're going to have in your account if you close all your positions right now. Simple. So the equity just tells you this is the amount you're going to have if you decide to close all your positions right now. This is what your balance is going to be. Okay. The next we're going to look at is line and candlestick charts. Line and candlestick charts. Glory says you mentioned floating profit. What is that? It means an open position that is, floating in profit, that hasn't hit your take profit or that hasn't hit your stop loss. So it's just, it's just floating. It hasn't hit your take profit level. Just like I have this trade right now, I haven't closed the trade, so it's floating. Like it's just, it's on. It's on and it's just floating. That's what I meant by floating. Okay. Someone is asking what's the margin call level. OctaFX margin call level is 25%. 25%. Okay, we're going to talk about line and candlestick charts. And a line chart is a chart that draws a line from one closing price to the next closing price. When strung together with a line, we can see the general price movement of a currency pair over a period of time. So let me show you guys what a line chart looks like. Okay. So this is what a line chart looks like. It just shows us closing price. The line chart is simple to follow, but it may not provide you as a trader with much detail about price behavior within the period, right? All you know is price closed at this period of at the end of this period. You don't have any clue about what happened during that period. Okay, so it doesn't give you like details, right? Which is why I'm going to talk about candlestick charts, because it's popularly used by traders, and it gives you much detail about what happened during this specific period of time and how the price reacted and all that. So a candlestick chart is a single bar which represents the price movement of a specific currency pair for a period of time. The information it displays includes the open, high, low, and close for that time period. Okay, so this is what a candlestick chart looks like. I mean, it may not be these colors on your trading platform, but this is what it looks like. Okay, you may have like green and black or black and red, but this is what it looks like. Now, I'm going to talk about the examples, the advantages of a candlestick chart before I go to talk about the examples and how candlestick chart patterns look. Okay, so the first advantage of a candlestick chart is they're easy to interpret and they're good for beginners to start figuring out chart analysis. Candlesticks are easy to use. Your eyes adapt almost immediately to the information in the bar notation. Candlestick and candlestick patterns have names which would help you to remember what the pattern what the candlestick pattern means. So you have like candlestick patterns like shooting star, engulfing candlestick, doji. This candlestick have really nice names that would help you remember this is what this pattern means and this is what's going to happen, gives you like a direction. Okay, we also have a video that explains that in detail in the description box, the English playlist. Okay, so the fourth advantage is candlesticks are good at identifying market turning points, trend reversals from an uptrend to a downtrend, or a downtrend to an uptrend. So when you see like engulfing candlestick, or you see like a morning star and an evening star, you know that the morning star is trying to tell you the market is trying to reverse, turn into an uptrend. The evening star is going to tell you the market is trying to reverse and turn to a downtrend, stuff like that. Okay, so candlestick patterns can be bullish or bearish. Candlestick patterns can either be bullish or can be bearish. Let me give you guys the example I was talking about. So every chart has its own advantage and disadvantage. You can choose any type for your technical analysis. It all depends on your personal preference. Okay, the data may be the same to create the chart, but the way the data is presented and interpreted may vary. All right, let's talk about the examples of candlestick patterns. So like I said, candlestick can either be bullish or bearish. Now the candlestick shows you the open, the low, this is the opening point, the low, the high, and the closing, right? So when you see a candlestick like this for a bullish candlestick, you just know that the bullish candlestick opens at the low and closes at the high. That is why it's a bullish candlestick, because it opens lower and closes higher. Now, one thing you should take note of when reading candlestick is the opening point and the low. This is called a wick, W-I-C-K. That's what's called. A wick, yeah, like that. So it's just giving you like it's just trying to tell you that at some time within the opening and closing point of this period of this candlestick, price was at this point, right? The sellers took the price at this point, so it just gave like a trace. As a trader, it gives you a trace to tell you, okay, market was at this point, during the opening and closing period of this candlestick. For a bearish candlestick, it opens higher and closes lower, right? Because it's heading downwards, right? Bearish, when you hear bear, sell, down, So, like I said, you take note of the opening point and you look around for the highest point, the lowest point, which are these traces, this wick, and the closing point. So you have like candlesticks that have big or large real body and small wicks, and then you have these candlesticks that have a very long wick and a small body, a very long wick and a small body. How do you read this candlestick? Remember, you just check, it's a bearish candlestick or a bullish candlestick. If it's a bearish candlestick, you just have at the back of your mind that a bearish candlestick opens higher and closes lower, right? So this wick is going to just tell you that at some time during the open and the closing period of this candlestick, the buyers took charge and created this high before the sellers took it down to close it down here, right? Took it below the opening price. So when this candlestick opened, buyers took charge, and then there was this rejection by the bears. They rejected this candlestick from going any further and came to close it below the opening price. That's why it's a bearish rejection candlestick. Now you have this bullish rejection candlestick that indicates rejection by the bulls. So the same thing, it's bullish because it opened lower and closed higher, right? So when whatever candlestick that opens lower and closes higher is a bullish candlestick. So this wick indicates or tells you that at some point the sellers took charge and the sellers, I mean the bears, they took charge and they were rejected by the bulls to close this candlestick above the opening price. And then you have this candlestick that has the same opening and closing point and the same high or low length. Sometimes the high and the low may not be the same, but they'll just have, opening and closing point. This is a doji candlestick. It means indecision. Okay, neither the buyers or the sellers were able to take control or take charge of this candlestick. Michael Moses says, how do you know about the length of a period represented by a particular candlestick? It's all in your time frame. If you go to your trading account, if you go to your trading platform, you're going to see different time frames, right? What this means is every candlestick here, like we have M1, which means 1 minute. Every candlestick here opened and closed, within 1 minute. Okay, every candlestick here opened and closed within 1 minute. So if you go to like 15 minutes, tells you that every candlestick here opened and closed within 15 minutes. The same thing for 4 hours. Every candlestick here opened and closed within 4 hours, and so on. Okay. Let's talk about spread. Spread. What is spread? Spread is the difference between the lowest ask price and the highest bid price, which is measured in pips. The bid price is always lower than the ask price. Now, if you go to your trading platform, OctaFX spreads are really tight that you have to go to the lower time frames to actually see the spreads. So yeah, so if you can see, I have 2 lines here, a red line and a blue line. Now they are differentiated by a small gap. This red line and blue line is called the ask and the bid price, where the prices that traders buy and sell at, right? They are differentiated by a small gap, which is called the spread. Now, in order for you to get the value of the spread, you have to subtract the ask price from the bid price. Okay, so another way that you can find the spread is to just go to your market watch and click on spread. Right click and click on spread, so you actually know what spread is for a currency pair. Just like you have USD JPY, the spread is 1.3, and like you have 13, it's actually 1.3. Euro USD is 0.8, USD CHF 1.1, and pound dollar 1.5, 1.6. So that's like the difference between the ask and the bid price, the buy and the sell price. Think of spread like this. Let's say I'm going to the bank and I want to change my naira for dollar. Now, the price that the bank would actually sell dollar to me is going to be different from the price that the banks would buy dollar from me. So that difference is called the spread. Okay, that difference is called the spread. Okay, now another important thing to note is that currency pairs have different spreads, and it's actually it depends on the liquidity of the currency pair. So the more liquid the currency pair is, the tighter its spread. Okay. All right. I'm just going to go ahead and answer your questions if you have any. Like I said, if you have any questions at any time, just type in the comment section and I would look to answer your questions. Glory is asking, what did you call the candlestick that looks like a cross? I called it a doji candlestick. Doji. Let me put that up. Doji, D-O-J-I. rather, DOJI. It's a doji candlestick. We have a video that explains in detail candlestick patterns. It's in the link in the description, English playlist, so you can click that after this video and understand candlestick patterns. Then you come back to rewatch and refresh your memory and understand better about everything I just taught today. Okay, what is the bullish candlestick? The bullish candlestick is like a candlestick that opened lower and closed higher. Okay. How can the week tell you about a trade? Okay, so here's what's going to happen. Let's just read this candlestick that is just forming right now. Notice how, let me zoom in a little bit. This bullish candlestick, it's actually bullish because the price is above the opening point. It's bullish because price opened here, yeah, and now it's bearish because the sellers have taken over. Now this week tells you that at some point between the opening and the closing time of this candlestick, the buyers were in charge. Market created the buyers were in charge, and they created this new high, this high of the candlestick. So it tells you that okay, at some time in this candlestick the buyers were in charge, but the sellers took them down. Okay, so yeah, the candlestick closed bullish because it closed above the opening price. So that's just exactly how to use the week and how to read a candlestick. Okay, so let's look at what we have next in the next webinar. What we're going to be talking about next, we're going to be talking about predicting the market, which is another amazing topic under workshop or online workshop for complete beginners series. We're going to talk about orders opened and closed by market price. We're going to talk about the four most important types of news, NFP. We're going to talk about CPI, GDP, Fed. I'll explain those in detail, non-farm payroll, consumer price index, all that, explain it in detail. And we'll also talk about take profit and stop loss and why you need take profit and stop loss. And we'll look at fundamental and technical analysis. Now, if this video was informative, which I think it was, go ahead and hit the like button and subscribe to OctaFX YouTube channel. Hit the bell icon so you don't miss out on new episodes. And I'll see you guys in